Hello, welcome to topic 5 of financial reporting unit titled Foreign Currency Transaction. For this unit or topic, we will discuss about two major contents. The first one is recording foreign currency transactions and determining functional currency and presentation. For foreign currency transactions, there are two major issues that we will consider and we will discuss. The first one is where debts, receivables, or other monetary items are denominated in currencies other than that domestic currency. There is a need to convert them into a single currency and not necessarily in PNG Kina. Unless transactions converted into a common currency, financial statements would include account balances in different currencies. Where an entity controls a foreign subsidiary, there is a need to translate the accounts of the subsidiary into a common currency before consolidation process. So which means if there is a subsidiary operating here in Papua New Guinea and there is a parent, the parent company is situated in Australia, so before the subsidiary's financial statements will be consolidated to parent company which is in Australia, it has to be translated first to the common currency. In this case, because the consolidation will happen, it will be under Australian dollars when they consolidate the report. Examples of foreign currency transactions are acquisition of goods from a foreign supplier where the transaction is denominated in a foreign currency. This is an example of importation. Sale of goods to a foreign customer where the transaction is denominated in a foreign currency. This is an example of export activity. And then loan from foreign lender denominated in foreign currency, which as a company we had asked for a loan, and when we are recording it and also paying it, it should be denominated in a foreign currency. As per IAS 21, the definition of exchange rate is the ratio of exchange for two currencies. As we know, exchange rates frequently change day to day, and this result is requiring us to update our recorded transactions or translations. For journal entry, we need to remember these three terms. The first one is spot rate or spot exchange rate. This is the exchange rate for immediate delivery. So for example, if you're buying goods now, the exchange rate prevailing for this period will be the one to be used in measuring the transaction if it is using the current exchange rate. The second one is functional currency, the currency of primary economic environment in which the entity operates in. So here in Papua New Guinea, we are using Papua New Guinean Kina. And last, presentation currency, the currency which the financial statements are presented. The presentation currency may not be necessarily the functional currency. Again, it depends on the requirements or which currency they will use in preparing report. Where consolidated financial statements are prepared, transaction will be first translated into a particular functional currency, and then prior to consolidation, the subsidiaries' financial statements will all be translated into the group's single presentation currency. Again, coming back to my example, if there is a subsidiary operating here in Papua New Guinea and the parent company is in Australia, the first thing that we will do is, of course, prepare the report here in Papua New Guinea based on the functional currency, and then afterwards we will translate it into the parent's presentation currency. So in my example, that will be in Australian dollar. With regards to reporting date adjustment, foreign currency monetary items outstanding at the reporting date must be translated using the closing rate. So of course, the closing rate is the spot rate at the reporting date. Examples of foreign currency monetary items: this includes accounts payable and receivables, cash, interest, notes, loans and dividends receivable, bank overdraft, income taxes, wages, notes, and or debentures payable. So these accounts needs to be at the or reported at the closing rate. Now any difference, of course, will realize gains or incur losses. So that will be reported under profit and loss statement. There are exceptions for this rule. The first one is qualifying assets, which we will discuss later on, and then cash flow hedges. Let's have an example. On 1st May 2019, Woodward placed an order for $3 million worth of inventory with Kraft Foods Inc., a US supplier. The goods were purchased FOB Chicago. The goods are shipped on 31st December 2019 and are paid for on 31st December 2019. And then we were given the following rates. We have the dates: 1st May 2019, 31st October 2019, and 31st December 2019 with their equivalent spot rate. So we are required to journalize the transaction above. Okay, notice on 1st May 2019 there is no entry. The reason is that the transaction is FOB shipping point. So which means if the product is not yet delivered, the ownership of inventory should still be with the seller. But on 31st October 2019, the inventory was shipped and we have this entry. This is the time that the buyer will have to recognize the asset account and they have to recognize the obligation or the liability in paying this amount. Now, the first entry is debit inventory and credit accounts payable. That is 10,526,315. Now we can calculate the amount to be recorded. Again, we have to translate or convert the amount from US dollars into Papua New Guinea kina. I have shown you the specific rates. Okay, so in this case, this is 3 million US dollars divide $0.285 per kina. So we have arrived at this amount. So that's the first record. Then on 31st December, before we settle the liability, we have to recognize whether there will be exchange loss or exchange gain. So in this case, there was an increase in accounts payable of 37,065 kina based on the calculation. Now, if there is an increase in accounts payable, it means that there will be a foreign exchange loss. Then afterwards, after you calculated all the accounts payable plus the adjustments on foreign exchange loss, then we will settle the account. So that is debit accounts payable and then credit cash on 31st December 2019. That will be 10,563,380 kina. So be mindful of the conversion. Usually that is the tricky part on this foreign currency transaction. So you need to be aware of the changes in the rates and then adjust the relevant account. So in this transaction, accounts payable is the foreign currency monetary item, so which means we have to adjust it. Now, regarding qualifying assets, IAS 23 has provided the definition of qualifying asset as an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So these are the assets that usually needs to be constructed or manufactured in a long period of time. So the discussion here is with regards to whether the interest or the exchange losses or gains should be capitalized, okay, while the asset is being constructed. Now, as continuation of the discussion, it says exchange difference that lead to an increase in the cost of an asset are considered to be borrowing costs. So for qualifying asset, IAS 23 requires the borrowing cost to be capitalized as part of the cost of the asset. Alright, this is an example of foreign currency transaction relating to a qualifying asset. On 1st January 2019, Ilimod Dairy Farm entered into a binding agreement with a New Zealand company to construct a machinery. The cost of the machinery was 500,000 New Zealand dollars. The machinery was completed on 1st December 2019 and shipped FOB New Zealand on that date. The debt was unpaid on 31st December 2019. The following are exchange rates for this transaction. Okay, we have 1st January 2019, we have 0.4311 for New Zealand dollars per Papua New Guinea kina. And then we have 0.4302 New Zealand dollars per Papua New Guinea kina. And then on 31st December, we have 0.43 New Zealand dollars per Papua New Guinea kina. So the solution is because this is a qualifying asset. Okay. And it's, again, qualifying asset is an asset is being constructed for a longer period of time. Okay. So it will be qualified as such from 1st January to 1st December 2019. Therefore, the movement of the exchange rates to 1st December 2019 would be incorporated in the cost of the asset. Any subsequent movements would be included in profit or loss. To journalize, on 1st January 2019, we will record the machinery on debit and then on credit accounts payable. Again, you have to convert the amount from New Zealand dollars into Papua New Guinea kina. The next journal entry is on 1st December 2019. As you can see, instead of foreign exchange loss, we are debiting machinery and then crediting accounts payable. The difference between the exchange rate conversion as at 1st December 2019 and also comparing with the previous accounts payable. Again, because this is a qualifying asset, any increase in the cost of accounts payable in this case will also have an increase in the asset account. And then afterwards, after the completion of the machinery, then we will have to recognize foreign exchange loss or gain on payable or accounts payable for the machinery. Again, from 1st January to 1st December 2019, the machinery is being constructed. So which means any increase in the cost of the machinery during that time will be capitalized. But subsequent to that period, any changes in the amount will be charged to foreign exchange loss or gain, depending on the effect of the transaction. The last slide on this presentation is with regards to translation to presentation currency. The result and financial position of an entity whose functional currency is not the currency of a hyperinflationary economy shall be translated into a different presentation currency using the following procedures. The first one, assets and liabilities for each statement of financial position shall be translated at the closing rate at the date of the statement of financial position. Income and expenses for each statement presenting profit or loss and other comprehensive income shall be translated at the exchange rate at the date of the transactions. And then the last one, all resulting exchange differences shall be recognized in other comprehensive income. Now, comparing with the conversion that we have done from the previous slides, any differences on the exchange rate there will be charged to profit or loss statement. But here, any differences in the translation to presentation currency will be recognized in other comprehensive income section. And that ends our presentation recorded lecture for foreign currency transaction. For the next presentation and video lecture, we will have a sample exercise to further understand how to journalize foreign currency transaction.